Hello, this is Ryan Mahoney, Associate Advisor and Retirement Plan Specialist here at Cypress Asset Management. In this presentation, we will be discussing the components most essential to successful retirement planning. Whether you are currently participating in your company's retirement plan or if you are considering participation in the plan at some future date, it is our hope that this brief presentation will serve as a helpful resource when it comes to planning for your retirement. Before we begin, I want to first share with you our contact information so that we can answer any questions that you might have after viewing this presentation. We can be reached at 309-679-9146. Our office hours are from 8 a.m. to 4 p.m. Monday through Friday. We will begin our discussion with the concept of budgeting, as it truly is the first step toward taking control of your finances and therefore your retirement. The benefits of creating and rigorously maintaining a budget are many. On the one hand, it helps to establish goals. It also prevents spending from outside our means and keeps us out of debt. It establishes discipline in our approach towards savings, and it affords us peace of mind that comes with knowing that we are in control of our financial destiny. Without effective budgeting, planning for retirement is essentially impossible for most of us. We all typically know how much we earn, but without understanding and controlling our expenses, we might not have the extra income needed to save. According to a recent study conducted by the website bankrate.com, only 44% of Americans have more than $25,000 in their savings. Ensuring that you have enough money saved so that you can live a financially secure life should be a top priority. And it's never too late to start. There are many resources available to help you, including this one. So let's talk about the basics of budgeting and what it entails. After you understand what budgeting involves, you can then begin to keep track of where your dollars are going each month. And the way we do this is simple. First, make sure your needs are covered. Second, estimate all necessary expenses. Third, determine the difference between your monthly income and monthly expenses. Fourth, manage your debt and savings. 5. After you've taken care of your regular bills, you can then begin to think about saving for emergencies and ultimately retirement. 6. Always avoid overspending. And 7. Set the groundwork for a successful future. There are many ways to track your income and expenses. You can use a basic outline as found in Microsoft Excel, or utilize a free service such as Mint.com to track your spending habits for you. In addition to tracking your expenses monthly, there are many other ways to safeguard your savings and spending habits. You can use money management software and apps. These can help you link your accounts and track your spending and savings for you, and even alert you if you're overspending in one category. You can also make use of auto bill pay, set specific dates that you'll pay, as this saves time, effort, and makes sure everything is paid on time, avoiding late fees. And many banks offer alerts when you've reached your spending limits. We've done some research to show you on average how much you should be spending on what are likely the top 2 most income-consuming categories in your budget. Many people make the mistake of spending too much in these 2 areas, thereby leaving them with less discretionary income and savings. The goal of sound budgeting is ultimately to save money for your future, and having extra savings stored away for one's retirement years might prove to be even more critical than for previous generations. This is because average life expectancy is increasing, and to adjust for this development, the federal government continues to slowly raise the full retirement age for those of us still putting into the system. There's also a very real possibility that future Social Security pensioners will simply receive less money than what is currently being promised to them. These points considered, we advise participants to view their Social Security benefit as merely supplemental to their retirement income. It should be one source of retirement income, but not the only source. Once you have established a working budget and built up your emergency fund, the next consideration to make is with regards to investing. It is best to think of investing not as an end in itself, but rather as a means to an end, the end being, of course, your retirement. Investing is but one component, albeit a very important component, comprising your overall retirement plan. The amount of money you invest, the growth rate of your money, and the amount of time it takes this invested money to grow constitute the three essential elements to consider when it comes to successful investing. We have already discussed the issue of Social Security and the importance of having additional sources of income from which to draw during your retirement. But just how much should you save for this retirement? The chart featured here offers some general benchmarks based on one's current age and current savings as a percentage of their annual salary. So, for example, if you are currently 25 years of age with no savings to your name, you should be aiming to save roughly 8% of your income. Please note the assumptions when making use of this table. To emphasize the importance of saving and the pronounced difference it can make in your retirement, we present the following scenario. Consider 3 workers, all 24 years of age, and all making $40,000 a year in wages. They choose to save 7%, 10%, and 15% of their respective incomes, the proceeds of which go into their company's retirement plan, which then earns 7% interest compounded annually. Now observe the difference in end values. The worker who saved only 7% of their income has just over $500,000 awaiting them in retirement, whereas the more prudent saver, saving 15% of their income, has over $1 million awaiting them in retirement. If saving, say, 10 to even 15% of your income for the purpose of contributing it towards your retirement plan sounds out of reach or unfeasible, you might consider creeping your contribution level. Gradually raise your contribution amount by 1 to 2% each year until you reach your goal. Such a slight increase, while marginal in the short term, can make for a significant difference in your future retirement income. Here we can see the power of only slightly increasing one's contribution level. We have a worker earning $35,000 in annual income over the course of 25 years. If this worker opts to save 6% of their paycheck, or $81, they'll find they have just over $133,000 waiting for them at the end of the 25-year period. However, if they can bump that savings rate another 6%, which would mean saving an additional $81 per pay period, they'll find they have over $266,000 waiting for them at the end of the same 25-year period. That is a huge difference and would no doubt make for a more comfortable financial situation in retirement. Now, if you are watching this presentation, it is safe to assume that we, Cypress, are most likely the investment advisors overseeing your company's retirement plan. For all of the company plans that we manage, we utilize investment vehicles known as index funds, as these are typically the lowest cost mutual funds available to everyday investors. In addition to this benefit, index funds also seek to give their investors the market return of their respective asset classes. In other words, we are not trying to beat the market with exceptional returns, but rather we are attempting to capture what the entire market returns. This strategy allows us to keep our trading costs much, much lower than our active counterparts who attempt to pick winning stocks and time the market with their buys and sells. Implicit to our strategy is also a broad level of diversification, which means our funds are not consolidated in a mere handful of stocks, but instead are comprised of over 1,000 stocks. The quilt-like graphic shown here highlights the downright randomness of the global economy. Each color seen in the chart represents a specific asset class. And if you look at the top left-hand corner, for example, you can see that real estate was the top performing asset class for the year 2006. In 2007, it was emerging markets. In 2008, it was U.S. investment-grade bonds, etc., etc. Now try as you may, there is no discernible pattern to be found among these asset class squares. Asset classes that perform exceptionally well in one year, real estate for example, often prove to be the worst class in the subsequent year. With such obvious randomness exhibited by the global market, it is truly a fool's errand to try and predict which asset class will perform the best, when it will perform the best, and for how long. This is why we champion an indexed approach to investing. Having touched briefly on the importance of indexing, let's now discuss the other equally, if not more important, determinant of successful long-term investing: investor behavior. The financial research company Morningstar produces a report each year called Mind the Gap, in which they examine trends in data and they look for signs of what leads to better or worse results for investors. And generally what they found was that investor returns fall short of a fund's stated time rate of returns because people, or investors rather, tend to buy after a fund has gained in value, and they tend to sell after it has lost value. For the 10 years ending 12/31/2016, the gap in earnings caused by investor behavior was 37 basis points, or 0.37%. This Mind the Gap study produced by Morningstar demonstrates the tendency for investors to jump in or out of the market at exactly the wrong time due to either fear or greed or something they might have read in a magazine or seen on TV. Such behavior ends up wreaking havoc on the value of an investor's portfolio long term. As this chart demonstrates, the S&P 500 has performed remarkably well over the time period from 1970 all the way through 2021. In that time frame, and in general, the stock market has had a tendency to go up over time. But unfortunately for those of us along for the ride, the market does not move in a straight line. One strategy to potentially mitigate the risk of buying in at the wrong time is to practice what is known as dollar cost averaging. And this is one of the benefits, too, of contributing to your 401k plan on a regular basis. You can take advantage of this strategy. So what is dollar cost averaging? Well, it is a strategy of buying a set dollar amount of a specific investment on a regular basis, regardless of the share price. So you buy more shares when the price is low and fewer shares when the price is high. Over time, the average cost of shares may be lower, and the risk of investing one large sum of money in a single investment decreases. The following example might help to clarify this concept. Let's say you decide to defer $100 of your monthly paycheck into your 401k plan. And you're going to buy $100 worth of DFA's ABC fund. In April, ABC fund is worth $20, so you purchase 5 shares with your $100. In July, however, ABC fund is worth only $10, so now you purchase 10 shares, still equaling $100. In November, ABC funds is now worth $25, so you can only purchase 4 shares. In total, you have purchased 19 shares for an average price of $15 per share. As we near the end of our presentation, let's conclude by reviewing what has been the entire purpose of this talk: getting you ready for your retirement. We have already touched on the importance of saving and the importance of discipline or proper investor behavior in the market. The investment factor, however, is a bit more nuanced than the other two. There's a bit more here to consider when it comes to prudent investing, and it's up to you, the individual investor, to ultimately decide what is the proper investing approach to best meet your needs and goals in retirement. If you've made the decision to begin contributing to your company's 401k plan, you will then need to determine how you would like your contributions to be invested. Will you put them in riskier funds? Funds, for example, that have exposure to emerging markets or possibly real estate? Or will you invest in a fund that is largely comprised of less risky assets like government bonds, for example? Now, if you're unsure as to how to answer these questions, don't worry, there's no right or wrong answer. Ultimately, you need to try and determine your tolerance for risk. The questionnaire featured here can help you determine it, and we strongly encourage you to take a few minutes and answer it, especially if you have no previous investing experience. Let it be known that investing is a risky endeavor by its very nature, and the possibility of loss is very real. While ultimately it is up to you to decide how you would like to invest your money for retirement, we like to offer some general benchmarks to help you determine your strategy. When it comes to determining how much risk one should expose themselves to via their investment portfolio, age typically plays a critical role, and the reason is simple. Younger investors have more time for their portfolios to rebound from possible downturns in the market, assuming they stay disciplined and do not exit the market by selling when prices are low. Older investors, however, who are near their retirement, must be much more defensive with their portfolio because they don't have the luxury of time like younger investors do to recover from a large downturn in the market. The 5 professionally managed portfolio options available for your selection in your company's 401k plan are represented here in this slide, each with its respective asset allocation. Once again, the age ranges listed below each portfolio are merely suggestions, not hard and fast rules that one must follow with their investing strategy. The important takeaway here is that as you begin to start saving for your retirement, whether you've already started or you plan on starting today or at some future date, you must consider your risk exposure and your age. Taking too much risk with your investments as you near retirement age could spell financial disaster in retirement, though taking too little risk in your younger working years could also lead to the same result. The key here is to strike the proper balance between age and asset risk. Now, if you're already contributing to your company's 401k plan and are concerned that you're taking either too much or too little risk with your investments therein, do not worry. You can change your asset allocation whenever you'd like. It's an easy and simple process and can be done via the online portal. If, after viewing this presentation, you are still unsure as to how you should be investing your contributions, then please do not hesitate to contact us here at the Cypress office. Again, our number is 309-679-9146. We do hope that this video has been helpful to you. On behalf of myself and the retirement team here at Cypress, we want to wish you all the best on your journey towards reaching your life and financial goals. Take care.